Hey, what's up, guys? Welcome back to the channel. Today is Sunday, the 28th of January, and this is my second time doing this video. I just recorded it. It was a fire video, and I don't know what happened with Camtasia. So take number 2, Sunday Night Football, and the Ravens are not getting the job done. As a board member of the Taylor Association, kind of getting sick of the whole Taylor Swift thing. But alright, y'all, question of the week. Is this the week the market finally pulls back? Can the unthinkable happen, and can we pull back a bit? So a few things to be mindful of. The economic calendar. A couple biggies this week. So on Wednesday, we're going to hear from the Fed, JP and the boys. And then on Thursday, we got the jobless claims. So keep an eye on that. And then earnings-wise, a couple of heavy hitters. Off the top of my head, Amazon, Meta, Microsoft, Google, and Apple. And those 5 stocks make up about 20% of the S&P 500. So they might be meaningful. Putting earnings and the economic calendar aside, here's the biggest issue, if you want to call it an issue. And keep in mind, the market's going to do what the market want to do. But on the big 3 board here, obviously things are bullish. S&P's and QQQ, monthly chart, 10 out of 10. Weekly chart, 10 out of 10. As is the daily, as is the 4-hour. So everything's bullish, right? Your structure, rock solid. Momentum, tank full of gas. Everything lined up for higher prices. Probabilities-wise, here's the problem. So I'm working on these labels for us. And I had been working on them a few months ago. The coding kind of kicked my ass. But I think I've gotten it figured out this weekend. So, risk reward. QQQ daily chart. The risk is 2.1. Reward is 0.8. Now, that's measuring average true range moves from the 21 EMA and the upside target. Measuring average true range moves from the current price and the 21 and the target. So in terms of probabilities, do I want to build my trading career around risk-reward entries that look like that? If I'm wrong, I lose 2. If I'm right, I make 0.8. It's not going to work. If I have a 90% win rate, all right, then it can work. I don't want to bank on a 90% win rate, nor do I want to trade in a fashion where I need a win rate that good. So that ain't going to cut it. And then if we check out the weekly, not any better. Risk of 2.7 and reward of 0.2. And then the spiders, the itsy bitsy spiders. The weekly chart, some nasty stuff here. Risk, 3. Reward, 0.06. If I buy it tomorrow and it continues to push, awesome. If I develop the habit of doing that time after time after time, I'm going to get my ass handed to me. I'm going to end up homeless. And then the daily chart is in the same boat. Risk of 2.6 and reward of 0.3. Now, to give you a sense of what I'm looking for, the Google weekly squeeze. And we actually took profits on our Google trade last week. But as far as risk reward, that's how it's done. We found our squeeze. We're buying the bad boy right near that 21 EMA. We didn't catch the whole push to 3 ATR. It never made it that far. But point being, our risk was maybe half an average true range move, and we caught just about 2. So from an average true range point of view, we risked 0.5 to make 2. Pretty damn solid. On our NVIDIA trade, and we're still long NVIDIA, we bought that on the slingshot signals, which I hope all of you were enjoying. We pushed that in the update last week. We're buying it on top of that 21, risking no more than half an average true range move. We caught every inch of that push. Took our first trade back here, caught the breakout, caught the pump, took profits, took those profits, and opened up trade numero dos. So yeah, that's how it's done. When you can take an entry near the 21, ideally in a squeeze, you don't need a 90, an 80, or a 70% win rate. Your winning trades by default will be much bigger than your losing trades. So as a swing trader, that's kind of my dilemma right now. No lack of strength, No lack of good-looking big three scores. All right, everybody's rocking a 10 out of 10. I can't do too much with it. I can't do too much with it all the way up here. Now the other thing I'm seeing. All right, so the question is, all right, I got an extended market. How can I tell there's a growing chance we might actually pull back? And that, my friends, is when you want to look for negative divergences on lower time frames. And I've got one for you on the hourly chart. You always want to watch a relationship between momentum and structure. So momentum on the big three squeeze, it tops out on Monday the 22nd. Right? Do I got my dates right? I do. Momentum tops out on the 22nd. Momentum goes down, down it goes, down it goes. It breaks the zero line, keeps on going lower. What is price doing? Momentum's going lower. They keep on pushing the price up. They break it out. They gap it up. They keep trying to pump it, keep trying to pump it. With momentum below zero, especially when your bigger time frames are so overbought, that divergence is not sustainable. From here, one of two things will happen. One, momentum goes back above zero, and the market just rallies until the end of time. Or two, momentum breaking leads to structure breaking. Price goes under the 21. Price breaks to 50. The 21 breaks under the 50. At that point, you're getting a big three sell signal. So take the 5-minute chart, for example. And mind you, in the context of perfect monthly, perfect weekly, perfect daily, a 5-minute sell signal, not going to do too much. But take this visual pattern. This week, I want you to look for it on 30-minute and the hourly. I think 2 good time frames. But anywho, momentum tops. Down goes momentum. They keep trying to push up the price. They never fix momentum. Finally, the structure breaks. Price breaks to 21. Price breaks to 50. 21 under the 50. You're taking out that 200. Shit is getting nasty. If we get to a point where the hourly chart breaks down, then I think we're going to get our pullback. The level I think you should watch, initially 48.50. We haven't tested the hourly 50 since about 140 points ago. It done been a while. And then QQQ here real quick. This also has the negative divergence. Momentum finds a peak. Down she goes, and they keep trying to pump it. Now check out the 30-minute. Pay very close attention tomorrow morning to the QQQ 30-minute squeeze. Momentum topped all the way back here. They keep pushing it, Finally, a little break in structure. Under the 21, under the 50, 21 under the 50. We got ourselves a sell signal, and we got ourselves a squeeze. That kind of action, the sell signal, the divergence, the break in structure, all the way up there at 2.5 to 3 daily ATR, can lead to a pullback. Not a guarantee, not a promise, just a probability. There might be a good chance this week. Now, with all that being said, it's a bull market. So, monthly chart of the SPX, we can't forget about that big monthly squeeze. I can take you all the way back on the chart to like 1950. Historically speaking, getting heavily short, 2 dots after a monthly squeeze fire to the upside, not a good idea. You get steamrolled. Not a very good idea. Doesn't mean we can't pull back to daily support. Doesn't mean we can't pull back to weekly support. But developing this bearish mindset, this bearish narrative, when there's a big monthly squeeze, historically, a very crappy idea. So that's my way of saying, hey, if lightning strikes and we actually pull back, I want to buy the pullback. And I would like to buy a bit more NVIDIA. And if anything, I want to add to my current trade. I think we're up about 100%. But we have the, let me think, we got the March expiration 600, 610 debit spread. If we pull back, I'm probably going to buy a little bit more. And then Google, which has earnings this week, the weekly squeeze hasn't even fired. Like I said, we took our profits last week. We bought our debit spreads for about $1.30. I sold mine for $2.70. I think a few of the members sold theirs for $3. We did two purchases on Google. I think the first one was about $1.20 and the second one was about $1.30. So average it together, a pretty good trade. But the fact that the weekly squeeze still hasn't fired tells me as long as the market doesn't totally fall apart, and as long as earnings are a total disaster, this bad boy wants about $1.60. If I can get a dip, I'll try to get long and play for 160. So there you have it, y'all. A couple things on the economic calendar. Very big earnings, a very extended market, but also a very strong market. My best advice, watch your lower time frames, and then if anything, approach your market this week with a bit more of a day trade focus. That's my focus in my trading. That's going to be my focus in the mastery group. You don't have to reinvent the wheel when you day trade. The same setup I would look for on the Google weekly chart, the NVIDIA daily chart. That big 3 squeeze of the buy signal, I'm going to look for that on a 5-minute, a 15-minute, a 30-minute, and hourly. Everything's the same except the speed. The only thing that changes is just the speed. But the setup, the indicators, the triggers, the entries, the exits, same old song and dance. But alright, y'all, have a good night. Thank you for watching. And I guess at this point, go Detroit Lions. Adios, y'all.